studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
Throughout this course, we've explored many different tax planning strategies. We've discussed salary versus dividends, RRSPs, TTS, CPP, family salaries, child care planning, mortgage considerations, bonus timing, and corporate tax deferral. At this point, it's natural to ask a simple question: which one is the best strategy? The answer is illustrated by this slide. There is no single perfect tax strategy. The best solution always depends on the client's individual circumstances. Let's begin with the left side of the slide. Notice the 4 different clients sitting with the tax advisor. The first client is a young entrepreneur who hopes to buy a home in the near future. Their priorities include qualifying for a mortgage, building wealth, and protecting their income. The second client owns a family business and has young children. Their planning may involve child care deductions, paying reasonable salaries to family members, and balancing salary with dividends. The third client is approaching retirement. Their focus shifts toward investment income, preserving wealth, retirement cash flow, and deciding how to withdraw money in the most tax-efficient manner. Finally, the fourth client owns a rapidly growing corporation. Their priority is expanding the business, reinvesting profits, maximizing corporate savings, and taking advantage of tax deferral opportunities. Although all 4 clients own corporations, none of them have exactly the same objectives. That means they should not all receive the same tax advice. Now look at the puzzle on the right side of the slide. Each puzzle piece represents one of the planning strategies we've studied throughout this course: salary, dividends, bonus planning, RRSP contributions, TFS savings, CPP benefits, family salaries, child care planning, mortgage planning, corporate tax deferral. Each of these strategies is valuable on its own. But professional tax planning is not about choosing just one puzzle piece. Instead, it's about fitting the right combination of strategies together to create a complete, personalized tax plan. That's why the center of the puzzle is labeled Personalized Tax Plan. Professional advisors don't start by asking, which strategy saves the most tax? They begin by asking, what is this client trying to achieve? Once they understand the client's goals, they select the strategies that work best together. The balance scale at the bottom reinforces another important lesson. On one side is tax savings. On the other side are the client's personal goals. Great tax planning balances both. Sometimes minimizing tax is the right decision. Other times, paying a little more tax today helps the client qualify for a mortgage, build RRSP room, receive CPP disability protection, or accomplish another important financial objective. The lowest tax bill is not always the best financial outcome. Throughout this course, you've seen this principle repeated again and again. Every compensation decision creates trade-offs. Salary creates RRSP room and CPP benefits. Dividends reduce CPP contributions, but don't generate earned income. Bonuses improve corporate cash flow through tax deferral. Family salaries can reduce the family's overall tax burden when properly structured. Child care deductions may require paying salary. Mortgage planning may require higher reported personal income. No single strategy is always correct. The real skill of professional tax planning lies in knowing when to combine these strategies to meet the client's unique needs. The message highlighted at the bottom of the slide summarizes this perfectly. The best tax strategy is the one that matches the client's unique circumstances not simply the one that minimizes one particular tax. That mindset is what transforms tax planning from a series of isolated calculations into a complete financial planning process. In the next slide, we'll see exactly how professional advisors evaluate a client's situation and combine multiple strategies into one customized tax plan. In the previous slide, we learned that there is no single perfect tax strategy. The next question is, how do professional tax advisors actually build the right strategy for each client? The answer begins with asking the right questions. At the top of the slide, you'll see a decision framework that illustrates the planning process. Rather than immediately recommending salary or dividends, experienced advisors first try to understand the client's overall situation. They ask questions such as, is the client young or approaching retirement? Are they planning to buy a home? Do they have children? Do they need to build additional RRSP contribution room? Would CPP disability protection be valuable? And how much cash does the corporation need to retain for future growth? Each answer influences the final recommendation. Notice that every question leads toward one destination, a customized strategy. This is exactly how professional tax planning works. Instead of beginning with tax rules, advisors begin with a client's life. Now let's examine the 3 client examples shown in the middle of the slide. The first client is a young family. Their priorities include raising children, purchasing a home, building retirement savings, and protecting their family financially. For this client, salary may be particularly valuable because it creates RRSP contribution room, supports CPP benefits, and may also allow the family to claim child care deductions. Mortgage qualification is another important consideration, so sufficient personal income may also be required. Now compare that with Client B. This business owner is focused primarily on growing the corporation. Rather than withdrawing large amounts of personal income, they may prefer dividends, corporate savings, bonus timing strategies, and tax deferral techniques that leave more money available for reinvestment inside the business. Their strategy looks very different from the young family's plan. Finally, consider Client C, who is approaching retirement. Their focus shifts toward preserving wealth and creating reliable retirement income. Eligible dividends, RRSP withdrawals, CPP benefits, and TFSA withdrawals may all become important parts of their overall compensation strategy. Notice something important. All 3 clients own corporations, but each receives a completely different combination of tax planning strategies. That is exactly why there is no universal solution. Now look at the workflow across the bottom of the slide. Professional tax planning follows a structured process. It begins with a client needing to understand the client's goals and priorities. Next comes asking detailed questions about family, business, income, retirement, financing, and future plans. The advisor then analyzes the client's financial situation and evaluates the tax implications of different choices. Only after that analysis is complete are the most appropriate tax strategies selected. Those strategies are combined into the optimal compensation mix, balancing salary, dividends, bonuses, RRSP planning, CPP considerations, and other techniques we've studied throughout this course. Finally, the plan is reviewed every year. Why? Because clients' lives change, businesses grow, families expand, children become adults, mortgages are paid off, people retire, tax laws evolve. A strategy that was perfect 3 years ago may no longer be the best choice today. That's why professional tax planning is an ongoing process rather than a one-time event. The message highlighted at the bottom of the slide summarizes the entire philosophy. Professional tax planning is customized, not standardized. The value of a tax advisor is not simply knowing individual tax rules. The real value comes from understanding how those rules interact and selecting the right combination of strategies for each unique client. In the final slide of this course, we'll bring everything together into one complete tax planning framework that summarizes the entire journey from understanding a client's goals to creating long-term financial success. We've reached the final slide of this course, and it brings together everything we've learned into one complete tax planning framework. Throughout this course, we've explored many individual strategies. We've discussed salary versus dividends, RRSP and TFSA planning, CPP retirement and disability benefits, family salaries, child care planning, mortgage considerations, bonus timing, corporate tax deferral, and many other planning opportunities available to owner-managed corporations. But as you've now seen, none of these strategies should ever be viewed in isolation. Professional tax planning is a complete process. Let's begin with the journey across the top of the slide. Everything starts with understanding the client's goals. Before discussing taxes, a professional advisor first learns about the client's business, family, retirement plans, financing needs, and long-term objectives. Next comes gathering information. This includes financial statements, tax returns, corporate records, personal income, investment assets, and future plans. Once the necessary information has been collected, the advisor analyzes the available tax planning options. Only then is the most appropriate compensation strategy selected. That strategy is carefully implemented, with proper documentation and compliance. Important deadlines such as bonus payments, payroll remittances, RRSP contributions, and tax filing dates are monitored throughout the year. Finally, the plan is reviewed annually because both tax laws and clients' circumstances continue to change. When this process is followed consistently, the result is exactly what every client wants: long-term wealth. Now look at the center of the slide. Surrounding the words "smart tax planning" are the 8 pillars that support every successful tax strategy. The first pillar is tax efficiency. The goal is to legally reduce taxes by selecting the right strategies at the right time. The second pillar is compliance. Every recommendation must follow tax law, meet filing requirements, and be supported by proper documentation. The third pillar is cash flow. Tax planning should improve the corporation's ability to manage and retain cash whenever possible. Next comes corporate growth. Keeping the right amount of capital inside the corporation allows the business to expand and invest for the future. The fifth pillar is family planning. Many compensation decisions affect spouses, children, and the family's overall financial well-being. The sixth pillar focuses on life goals. Buying a home, funding education, retiring comfortably, or growing investments all influence compensation planning decisions. The seventh pillar is risk protection. CPP disability benefits, insurance planning, and financial security all play important roles in protecting the client and their family. Finally, the eighth pillar is annual review. Tax planning is never finished. The best advisors continually revisit the plan as clients' lives evolve and tax legislation changes. Now compare the two approaches shown near the bottom of the slide. Poor tax planning focuses on a single strategy. Its only objective is paying the lowest possible tax today. Unfortunately, that narrow approach often leads to missed opportunities, higher long-term costs, and financial decisions that don't support the client's broader goals. Professional tax planning is very different. Instead of relying on one technique, it combines multiple strategies. It provides customized advice. It balances competing priorities. And ultimately, it creates greater long-term wealth. That comparison captures one of the most important lessons from this entire course. The objective of tax planning is not simply to reduce taxes. The objective is to help clients build lasting financial success. The message highlighted across the bottom of the slide summarizes this philosophy perfectly. Tax planning is about combining the right strategies for the right client at the right time while remaining fully compliant with tax law. Finally, look at the journey shown across the very bottom. It begins with knowledge, understanding the rules. That knowledge becomes planning. Planning leads to implementation. Implementation is followed by regular annual reviews. And over time, disciplined planning produces financial success. As we conclude this course, remember one final principle. Every client is unique. Every business is different. And every compensation decision involves trade-offs. The role of a professional tax advisor is not to search for one perfect strategy. It is to understand the client's complete financial picture, thoughtfully combine the appropriate tax planning tools, and create a customized strategy that supports both tax efficiency and long-term wealth. That is the true purpose of smart tax planning and the foundation of lasting value for every client.